Good evening, traders and investors. Will back here with another one, coming to you with a Monday market recap. Hopefully you guys had a very good day in the markets, a very beautiful weekend, and I hope you are all ready for another very juicy week of earnings. Matter of fact, this is kind of the last big week of earnings. We had a huge week last week where 39% of all companies were reporting. This week, a little bit lighter, 11%, but we do have a lot of very fun names, a lot of the growth names coming into play over the course of this current week. Tonight, we had Palantir, HIMS, and Mercado Libre. We're going to talk about them in today's video. The rest of the week, though, a lot of very nice growth companies, AMD, Supermicro, Arista Networks, many others tomorrow on the Tuesday session, A-Lab as well, Wednesday, Uber, Shopify, AppLovin, Oscar, for those of you that like that one, NVO, you got Disney, Fortinet, Duolingo, Symbotic, so many very cool growth companies in the markets this week. Thursday as well, Trade Desk, Celsius Holdings, Rocket Lab, SoundHound, NewScale, Kratos, one of the drone manufacturers, Square as well. You have a lot of very nice companies reporting earnings this week, but overall, guys, no really very large market cap companies. Last week was a bit of a serious week, right? Understanding the tone from the big tech companies, a lot of pressure was on them to kind of uplift the markets. Last week was somewhat of a negative week for the markets overall, which did culminate in the infamous Friday market sell-off for the jobs report, of course. Now, in terms of how the markets reacted today, we were very well positioned in terms of the bulls taking back some of the control that they had lost on the Friday session, and we had a nice broad market rally, most of all of your sectors participating, which goes to reiterate the point that I was making on the Saturday and Sunday video as well, that although we can have some short bursts of sentiment in the markets, bullish, bearish, what eventually does still drive the markets long term is earnings per share and fundamental outlooks of these businesses, all of which we have gotten information on over the last few weeks. Earnings, as a matter of fact, so far have been quite good, with over 50% of all S&P 500 companies having reported so far. How have they done? Well, we would look to FactSet data to kind of understand the summary. Are companies beating on earnings? Are they beating on EPS? How is the outlook for the rest of the year? As a matter of fact, guys, it is still quite good, which is why it's very hard to dislodge the bulls from the current market conditions right now. It's very tough to get them to pivot from bullish to bearish, especially when you have good fundamentals. Take a look at the earnings scorecard so far, with over 66% of S&P 500 companies reporting. Well, 82% of them have reported a positive EPS surprise, and 79% of S&P 500 companies have reported a positive revenue surprise. So people, especially on a day like today and on Friday, are coming in to buy the dip based on the fundamentals of the market. Earnings growth was also very positive too. For Q2, the earnings growth rate for the S&P is 10.3%. That is actually pretty good. It's the third consecutive quarter of double-digit earnings growth for the index overall, a very good picture for the markets, all things considered. Given the concerns about the market tariffs, have analysts lowered the EPS estimates more than normal for S&P 500 companies for the third quarter, the upcoming quarter? Well, the answer is no. During the month of July, analysts slightly increased EPS estimates for the third quarter, and even going so far as to increase the earnings estimates for the full year. The calendar year 2025 bottom-up EPS estimate increased by 0.6%, which was also very good. You'll see that for the most part, guys, in terms of EPS for the calendar year, a lot of sectors actually got bumps. Communication services, financials, energy, materials, technology, utilities, discretionary, even consumer discretionary and consumer staples got an uptick. The only ones that got revisions to the downside, real estate, industrials, and healthcare. We know that healthcare has been performing pretty poorly recently, and the market is definitely punishing those negative EPS surprises. We haven't got very many of them, but a lot of them were in the healthcare sector. So overall, our earnings snapshot on our earnings reviews have been overall positive. Now, I will agree that the price action on some of the earnings releases was not favorable. We've seen time and time again this quarter where companies have had very good earnings numbers, but sadly, their stock price went down, which is where you have to kind of analyze if there's a disconnect between those two things, between improving fundamentals and the stock price. Sometimes they don't go hand in hand, which is why I always say, earnings releases, the day of earnings, the stock price can move either way. But if you focus on the long-term fundamentals of a business, sometimes those short-term earnings drops can result in very nice buying opportunities. So today, the market largely unpricing some of the damage that was done on Friday, but we also knew that the bulls had never lost control. Keep in mind, they had always had the weekly uptrends. We were always looking very good on that front, and we were looking for weekly higher lows. Now, the bulls have not recaptured the entire move. They will still have to kind of maintain this daily uptrend. The door is still open for the possible rollover. We are not ruling that out, but the bias is still bullish overall. The bulls do still control the longer and medium-term trends, and the fundamentals of these companies throughout this earnings season have been quite good. As a result, all dips will remain for buying. It's just the extent of the dips. How long will the dips last? That is a little bit difficult to predict, but I am still a firm believer that most of these dips are going to be for buying, even in spite of the choppy fall seasonality that we can possibly be heading into right now. We know that August, September, and October, very choppy months for the market with an overall downward bias. But, that's just one aspect. If the fundamentals of the market are good and the analyst expectations and corporate estimations are good and revised to the upside for the end of the calendar year, then we may just still have somewhat of a bullish leaning bias, even in spite of the fall seasonality. And do we have any dip buyers, especially on the institutional level? The answer is yes. If you take a look at the smart money versus dumb money confidence, you can see that on the Friday session, well, retail got a little bit shaken out of their positions, but who is there to possibly buy the dip? Institutions to the downside here. They have a lot of buying power. They've been offloading some positions throughout this most recent rally. So in the event that fall seasonality does take over and that the markets do have a little bit of a dip, just know that the big money is going to be there to participate overall, which leaves us still in a bullish leaning bias that we should be dip buyers in this current market, despite some of the short-term volatility catalysts that we can have. And even if it extends into a few weeks in terms of the market, I've been saying for the last few days since the jobs report, you have to kind of hope for the best for the price action, but expect the worst. And expecting the worst could maybe only be a 5 to 7% dip on the SPY, equivalent drops in the QQQs, possibly coming back down into some of our technical levels that we've been focusing on the charts for a couple weeks now. So that was kind of a long-winded introduction, but hopefully you guys enjoyed trying to kind of explain the differences between the fundamental aspect of the market, which is very good, and the short-term sentiment drop that can arise sometimes as part of these news releases that we get every now and then. In terms of the news releases for this week, guys, though, it's going to be a fairly light week. There's really not much to take a look at. Only tomorrow, ISM Services PMI, and then the rest of the week is very, very light. So you should not have any very bad macro surprises that could bring the markets down. But in the event that the job sentiment gets reiterated or whatnot, and we do find a bit of weakness, just always remember what I keep saying. Just focus on the weekly trends, guys. Who is in control? It is the bulls, and every single dip is looking for a higher low for possible further trend continuation. But as I always say on the channel as well, we will take it one day at a time. Every day in the markets, there are some beautiful long-term portfolio opportunities or even some short-term swing trade opportunities, and I'll do my best to bring the best of both worlds to you guys in every single video. Speaking about the videos, today we're going to do a few things together. Number one, we have a few earnings to recap. Those are going to be specifically Palantir, HIMS and HERS, and Mercado Libre. We'll focus on those three earnings to start off the video. Thereafter, we will dive into some technical analysis, see where the bulls are standing right now after the big sell-off day on Friday and today's recovery. Who is in control of the short-term timeframes? Because I'm sure that's what a lot of you want to know. We'll do our index analysis and check on the rotation as well. Once we're done that, we will dive into our big tech name list down here and all the fan favorite names. We'll derive some possible price action levels for some entry for either short-term trades or long-term portfolios. Towards the end of the video, I will focus a bit on the biggest gainers and losers of the day, of which there were many, especially in the green. So we'll focus on some companies that had great days today, and then also focus on some companies that unfortunately had very bad days today and derive any possible swing trades or long-term positions on a few of these companies. And to wrap it all up, I'll give you guys a glimpse into my portfolio for a few trades that were put on today and which trades I am keeping into the rest of the week as well. So it should be a very fun video, guys. Let's jump right into it, shall we? The S&P up 1.5 today. The Q's up 1.85. Very decent day of recovery, and it was broad market based. Take a look at the heat map. You'll see that most of all sectors were participating. Sadly, Amazon still getting a bit of a slide after their earnings. Fantastic company, though. I do believe it's a buying opportunity, and I've been saying that since their earnings release on Thursday. Berkshire also coming down, and then the energy sector. But overall, guys, many more names in the green, and big tech coming roaring back, and especially semiconductors really catching a big bid today. On the one-day relative, you can see that even better, to where most of all sectors, I mean, actually all sectors participating to the upside, led by communication services and technology. Communication services, I'll remind you, is largely Google and Meta. They both had 3% days, fantastic days for that segment of the market. On the 1 week relative, well, we know that we still had a bit of weakness at the end of last week. So recovering the losses from last week are probably going to take more than one day, but today is a start. Utilities and communication services still in the green in relation to last week, but there's still a lot of damage that was done, right? A lot of the other sectors still down multiple percentage points in relation to the most recent all-time highs. And investor sentiment actually got significantly better today, pivoting from the neutral mark, which we hit Friday, and now pivoting back into greed. Not too greedy, but starting to get a little bit greedy as people pile back in. All dips are currently being bought again. So moving on to our earnings segments, guys, we're going to start it off with the one that everybody wants to see, of course, and that is going to be Palantir. So Palantir, what a fantastic company. I'm very happy to be a Palantir shareholder, although every day I kind of question the valuation, but a lot of pressure was going to be put on Palantir's shoulders today to establish, do they deserve the valuation? Can they keep growing revenue? Can they keep growing government and commercial contracts as fast as they recently had? And the answer, as a matter of fact, was yes. Palantir coming in and smashing every single possible metric that they could. The stock right now up in the after hours, about 4.5%. Now, maybe some of you are expecting a bigger move by Palantir, but keep in mind, guys, coming into earnings, the stock had obviously rallied a lot, and coming out of last quarter, right, the bottom of April, the stock is obviously up a ton, 140%. So pushing those incremental gains is starting to be a little bit difficult, but the numbers were overall fantastic. Take a look at the EPS beat right here by 15.74% on the EPS versus analyst estimates, and a 7.04% beat on revenue. Let's take a look at some more easy numbers, shall we? Revenue up 48% year over year. That is fantastic growth by Palantir, and that's what the street wants to see, especially when a company is so overvalued. They really have to keep up those revenue growth rates and have to keep pushing the bar higher in terms of the guidance. But Alex Karp, the CEO, did not disappoint today. U.S. commercial revenue was up 92% year over year to a cool $306 million. First time, by the way, that Palantir has eclipsed $1 billion of revenue in a quarter. Operating margin continues to see some improvements as the company is not only growing the top line revenue, but is getting more efficient in terms of the bottom line as well. The operating income was also up 83% year over year. So as I was saying, top line revenue and bottom line earnings and operating income both moving in the right direction. The company can scale, can have operating leverage. Everything is getting better for the company. Let's take a look at the article real quick. Palantir tops a $1 billion in revenue for the first time and boosts guidance. Yes, a double beat and a raise by Palantir. That's what investors, both retail and institutional, were looking for. Here's what the CEO had to say. We're planning to grow our revenue while decreasing our number of people. This is a crazy efficient revolution. The goal is to get 10x revenue and have 3,600 people. We now have 4,100. So possibly looking to trim down the workforce, possibly using their own AI to kind of get more efficient as a company, which is very funny, kind of ironic, isn't it? The software analytics company also boosted its full year outlook guidance. For the full year, Palantir now expects revenues to range between, let's call it 4.15 billion, which is up from a prior guidance of 3.89 billion. Right, very strong boost on revenue guidance. Talking about a 4 or 5% beat on the revenue guidance. I mean, not a crazy beat, like in terms of a blowout, but it's enough. The street definitely liked that. But if you would have had a bit more in terms of guidance, right, then the stock would probably be up a little bit more in the after hours. But still, we can't complain, especially at these valuations. For the third quarter, Palantir forecast revenues between 1.08 billion and 1.087, beating an analyst estimate of 983. So not only increasing the revenue guidance for the full year, but also increasing your guidance for the next quarter. Palantir also lifted its operating income and full year free cash flow guidance as well, getting more efficient, driving more free cash flow to shareholders. The US government revenues jumped 53% from the year ago period, which we already covered. Don't worry, I'll show you some slides so that these numbers make sense. It has been a steep and upward climb, said Alex Karp, a descent that is a reflection of the remarkable confluence of the arrival of language models, the chips necessary to power them, and our software infrastructure. During the quarter, Palantir said it closed 66 deals of at least $5 million and 42 deals totaling at least $10 million, several very interesting new government contracts from the Army, and also several major commercial contracts as well. Net income, a highlight for the company, was up 144% year over year to about $326 million. This is Palantir's best quarter ever in terms of net income, guys. You are talking about 32.6 net income margins, which was up from 24% net margins in Q1. So the company really firing on all cylinders, as I said, raising the top line, driving more of that revenue to the bottom line, getting more efficient in the process. If we take a look at some of Palantir's slides, you will see that they do highlight their advancements. Rather, they're helping other companies with their advancements in AI efficiency gains, transforming healthcare operations with AI-powered insights. Even Fannie Mae here using AIP to accelerate mortgage fraud detection from months to seconds. That is absolutely nuts. And every single quarter, Palantir gives us some insights as to how are they helping people. So here you go, the State Department right here. We put the first application into production in 3 months using Palantir software, reducing the time it takes to clear candidates to the Foreign Service from 60 days down to 12. Very big efficiency gains. Here we have another company, which is a supply chain company, saying production schedules used to take us about 40 hours to put together. This can now be done in 30 minutes. That's the power of Palantir's software, making everything from, either military applications more efficient, but also a lot of the commercial contracts that they do. Palantir's software does a great job of finding efficiencies and really cutting the fat in terms of different processes that a company might have overall. So moving into actual financial slides for them, take a look at some of these revenue numbers, guys. They're insane, right? US commercial revenue numbers, 93% year over year. Commercial customer count, 64% year over year. Remaining deal value in the pipeline for Palantir up 145% year over year. Fantastic numbers overall for the business. Nothing bad to say. There's that massive boost in GAAP net income, benefiting from those over 30% net margins right now. Really good for the company overall. Operating margin trending in the right direction as well. Very strong. Rule of 40, that's just the revenue growth and the profit margins essentially. They are 94% top percentile range for Palantir. US revenue growth, 68% year over year. This is nuts, guys, in terms of the revenue growth. Fantastic overall, whether that's commercial or government, both things moving in the right direction for the company. And this is the overall numbers. We showed you US previously, but the overall direction of the business, high 40% range gains. That's what Wall Street wants to see, guys. I'll give you guys this insight right away. If they can keep growing revenue at 40% plus per year for the next, let's say 3-4 quarters, the share price will not be impacted so much. But we know that eventually the law of large numbers will catch up to them. The same thing that happened to Tesla, the same thing that happened to NVIDIA, the same thing that happened to Amazon, and all the other fantastic growth stories that we've seen in the market over the course of the last 10 years. These numbers will not last forever, and eventually the share price probably will normalize, but not just yet. The company doing a fantastic job of growing everything well above the 40% benchmark that kind of Wall Street has them to right now, right? Total revenue growth right there, 48%, very strong. And if you take a look here in terms of investments, guys, into their own business, we continue to invest aggressively in AIP and the US while driving operating leverage at scale, meaning that while they're scaling the top line, guys, the margins are definitely not suffering. Fantastic expansion of operating margins over the last 5 quarters for the business. US commercial customer count, that's up 64. As I said, just look at this nice progression on the US commercial customer count. Overall customer count, very strong. And overall commercial, not only US, up 48% year over year, guys. There you go. There's your 157 deals of at least 1 million, 66 of which were 5 and 42 of which were 10 million. You would be hard pressed to find anything wrong with this earnings report for Palantir, ending the quarter with 6 billion in cash and no debt whatsoever, and some very decent free cash flow metrics, by the way, $570 million. Now that's a fraction of what they probably should be bringing in relation to their market cap, but it's a very good number objectively speaking. So then the question becomes, of course, is this stock a buy? Well, let's have a look. In spite of all their massive gains, guys, and the gains are many, right? We don't have to talk about them any more than that. Palantir is now a very profitable company, going from negative net margins to positive. The growth rate as of right now, at least, is not a problem for them. Very smooth EPS expansion curve, very smooth revenue expansion curve, but you can see a lot of the analyst price targets are well below the stock price, not because the company's not doing well, but just because the company is so darn expensive. At $165 per share, their forward price to earnings ratio is 275. Even if you divide that by a fantastic EPS growth rate, and is still trading at a 9.82 peg. Companies start to get expensive, objectively speaking, not my opinion, but just in terms of the overall market, above a 2 peg. This is 5 times that, 9.82 peg. It is extremely high in terms of earnings growth metrics. Price to sales, guys, at $165 right now is an 83. Usually tech trades between 10 and 20. This as well, guys, is like 4 to 8 times how much a tech company should trade at, even one with such fantastic revenue growth metrics as Palantir. If you take a look at the 2027 price to sales metric, we're still trading, guys, around 100, right? So keep that in mind. It is a lot. It is a lot to be asking from this company overall. Even though the company is doing very well, the company is priced to absolute perfection right now. So unfortunately for me, this one is not a buy. It is a hold if you are a long-term investor for sure, because I truly do believe that the company long-term will be able to expand its market cap from the current 380 billion towards 500, possibly $600 billion as well. But it will be a long time before the fundamentals catch up to that market cap. Essentially, the stock price is going to be disconnected from its fundamentals for a while. But until something truly shows that the company is slowing down, the share price, in my opinion, will not be tremendously affected. Companies don't traditionally sell off for no good reason. You have to give people a reason to sell. And so far, that is not the case for Palantir. So as of right now, it is a trim for me, whether that's with using covered calls or just taking some profits that you've accumulated so far. It's a trim for me, and I have as well trimmed my holdings the entire portion of the rally. I'm very happy with the gains that I've made on Palantir so far, but right now it's getting a little bit excessive, but there is no red flags for this business as of just yet, other than the valuation, all things considered, and the shareholder base is very strong. People are very bullish about this company. The company has extremely strong sentiment, and we know that a stock's price sometimes is a reflection of 3 things: the fundamentals, the technicals, and sentiment. The fundamentals, very overbought. The technicals, arguably also very overbought, but the sentiment, guys, remains extremely strong for this business. So as I said, guys, this one cannot possibly be a buy for me. The numbers just don't make sense unless you have a timeline well beyond 2030. And if that's the case, no problem. But short term, guys, you have to make a lot of justifications in order to, kind of have the appetite for the risk that's associated with Palantir's valuation right now. But overall, fantastic earnings for the business. And that's everything that I had for that earnings report. Now, stock number 2 is going to be HIMS and HERS. So HIMS stock has also been a retail favorite, and a lot of pressure was on this company because we know that they've had a little bit of mishaps here with some of their partners, namely Novo Nordisk. You remember when they dropped that partnership a few weeks ago and the stock tumbled over 30% in one day? A lot of the focus was going to be on the GLP-1 aspect of the business. Now, I know it's not everything that they do, but that is the pressure that they're under right now. That is what's in the spotlight. And we were seeking to determine whether or not that loss of that partnership was going to meaningfully impact their business. Well, I'm happy to report, guys, that as a matter of fact, it hasn't that much. Now, the stock in the after hours is down roughly, I don't know, something like 10, 12% right now. Actually, 15. It was the last time that I was preparing these earnings, right? So unfortunately, guys, from the close, you're talking about a 13, 14% decline after earnings. But overall, guys, the numbers were actually quite good. They did miss on a few key metrics here, and we'll look into that as to justify the drop overall. So they did beat on EPS by 12.73%. However, missing on revenue by 1.24%. And when the company is trading so high, and we know that there's some concerns around certain aspects of their business, obviously, if you miss your revenue number, well, the market's probably not going to reward you for it, right? But let's get into some overall numbers for HIMS, and you will see that indeed they were quite good. So moving on to HIMS right now, revenue up 73% year over year. That was fantastic, although coming in slightly under the amount of revenue that they generated last quarter. Subscribers, this is a very positive metric for them, 31% year over year, up to 2.44 million. Obviously, it is a subscription service business, which is great for those recurring revenues. Adjusted EBITDA margins, still very good, but retracing from last quarter's high. Monthly revenue per subscriber was up 30% year over year to $74. However, also slightly shy of the numbers that we had in Q1. So you can see some of the Q1 Q1 to Q2 comparables are slightly softer, which also did contribute to the decline. You would like to see these uptick every single quarter. And adjusted EBITDA right here, 109% year over year. That was very good. But once again, a little bit of a drop off in relation to Q1, but year over year comparisons overall, very good. It's just the quarter over quarter, they struggle a little bit. So let's move on to the article, shall we? HIMS and HERS stock falls 10% on the revenue miss. Let's move into it. The company reported a net income of $42.5 million, which was not bad objectively speaking. That gives them a net margin of 7.8%, which was good, but Q1 was 8.4%. Now, this is a very good turnaround story for the business. A few years ago, this company was net margin negative, but so far for the better part of the last 4, 5, 6 quarters, they have been showing positive net margins. It's been a bit lumpy. Some quarters are higher than others, but 7.8% is not a bad number, objectively speaking. For its third quarter, HIMS said it expected to report revenue between 570 and 590 million. The midpoint is 580. This is next quarter guidance. Analysts were expecting 583, so coming $3 million short of the analyst estimates. That's another thing that leads to the stock price decline. The company said its adjusted earnings for the quarter will be between the range of 60 and 70 million. The midpoint being 65. Analysts polled were expecting 77.1. That is a big miss, guys. Talking about a 15+% on adjusted earnings. That's not going to cut it. So as you can see, the red, they're not really red flags, right? But the points, in favor of a sell-off after earnings are starting to mount right now. The tough quarter-over-quarter comparable numbers, and then you have some misses on revenue for this quarter, but also some misses on guidance for next quarter, both on the revenue metric, but also on the earnings metric as well. So keep that in mind. That's a lot of justification for why the stock is down right now. HIMS and HERS has faced controversy in recent months over its continued sale of compounded GLP-1s, which are cheaper, unapproved versions of the blockbuster diabetes and weight loss drugs, some of which are sold by Eli Lilly and others Novo Nordisk, of course, the official ones, right? Compounded drugs can be mass-produced when brand name treatments are in shortage. But the US FDA announced in February that ongoing supply issues had been resolved. So this is the gray zone, and Novo Nordisk actually sued them over this to where they're probably not allowed to sell compounded GLP-1s right now. They are still selling them, but as a result right now, the US government is not necessarily suing them, but Novo Nordisk is. Some telehealth companies, including HIMS, have continued to offer the compounded medications. It's legal for patients to access personalized doses of the knockoffs in unique cases, not broad general cases, such as if they are allergic to an ingredient in a branded product, for instance. But this is definitely not all of HIMS's customers, right? In June, HIMS and HERS share tumbled more than 30% after a short-lived collab with Novo Nordisk fell apart. The drug maker, talking about NVO, said HIMS failed to adhere to the law, which prohibits mass sales of compounded drugs under the false guise of personalization. Big accusations by Novo Nordisk. Are they right? Are they not? That is going to be determined, of course, possibly by US regulators. But so far, there is no intervention. So a lot of the focus on this company right now is on their GLP-1 suite of products, but the company offers many other different products as well, right? It's just that a lot of the focus now is on that GLP-1 segment, which investors have been kind of trying to parse through and paint the bullish picture that, HIMS is not only a weight loss solution company, they offer many other different products at the same time. So we do have some very good numbers for HIMS overall. You can tell that their subscriber count is moving higher and higher. Very strong, guys. These numbers continuously move higher, which is great for the company. Revenues also push higher, but you can see that little drop off here that hasn't happened in the last roughly 8 quarters. Usually it's been up and up and up. This is the first time that they've kind of come down from a recent quarter, so slowing down there on the growth in terms of that aspect. Monthly online average revenue per subscriber hit a high of $84 last quarter, but you can see that decline back down to $74, which is some numbers from Q4. So here's a bit of a slip. We'll see if it's going to be an ongoing thing for the company. Probably not, but they may see some lumpiness in their overall sales pipelines, but the online revenue continues to be very strong. In terms of their operating expense profile, are they able to scale revenue while controlling costs? As a matter of fact, yes. You can see their operating expenses as a portion of their revenue have been coming down, and for the most part, that is all segments, whether it's G&A, technology, R&D, operations and support, and marketing. The company is trying their best, guys, to bring down the expense profile as they scale up revenue, so you kind of got to give that to them. Net income also, as I was saying, is very lumpy right now. Very, very, very lumpy, but at least they're still net income positive. And as I said, they are controlling their expense profile. So I would not be nervous that this company goes back to net negative income territory overall. In terms of cash flow in the balance sheet, the year-over-year decline in terms of free cash flow, because they did come in negative here for free cash flow, sadly, negative by about 69 million. So you want to see what's happening. Well, the year-over-year decline in both free cash flow and operating activities was primarily driven by temporary working capital investments and an increase in CapEx as we continue to invest in the level of automation and broader capabilities of our underlying pharmacy infrastructure. At the end of the second quarter, we had over $1.1 billion worth of cash and short-term investments and approximately $1 billion worth of debt. So not that bad of a debt-to-cash ratio for the company, but you can clearly see this drop-off here because of that CapEx and the other working capital requirements. They used to be free cash flow positive every single quarter for the last 8 quarters. Now you have a bit of decline. So obviously that is one more point to the bears, resulting in the sell-off that we had in the after hours for this company. But can't really talk anything bad about HIMS, guys. They're expecting revenue by 2030 of at least $6.5 billion, which does give the valuation some room to expand and could still represent a decent opportunity out there for some upside profits in terms of the share price appreciation. And you can also see that the company is gaining market share against their competitors. Here you have them against several other telehealth companies such as 30 Madison, Roman Health Ventures, Noom, Curology, BetterHelp. You can see that this company over the past few years have really been swallowing market share, absorbing more and more total customers, and as a result, absorbing more and more of a percentage of total sales in the telehealth space. Now, HIMS product offerings is quite wide and is getting a little bit wider too. You'll see exactly what the business is expanding into and what they've had in the past. So the past few years, it was weight loss, mental health, dermatology products, and sexual health products. Now this year they will be adding menopause and testosterone as well. So the company really doing a good job of expanding its offerings and kind of taking the pressure off of its weight loss segment overall, which is the whole controversy with the GLP-1 drugs, of course. So that being said, guys, those are a few elements from their earnings. I know what everybody wants to know. Is the company currently a buy at the after hours share price right now of $55, coming back into this support range right here, which we established prior in the year back in the months of May and June. We came under it with the NVO news. We were able to mount back above that, and now we're back to $55. So is the company currently a buy at $55? Well, their current price to earnings ratio on a forward basis is an 83.3. That is not, it's quite high, objectively speaking. They're growing EPS at 17% year over year. It gives them a PEG ratio of 4.9, which objectively speaking is quite high. But keep in mind their EPS is kind of coming off 0 right now. They will be ramping this one aggressively over the next few years, and revenue is really where it's at, guys. This company's going to be able to scale revenue very decently, culminating in almost $4 billion by 2028. And as we saw in the slides, $6.5 billion by 2030. So the company does definitely still have some upside. I think that the best metric for this company arguably is price to sales. At $55 right now, they're currently standing at a 6 price to sales. Depending on whether you think it's a health company or more of a technology company, you can estimate that a fair price to sales for the niche that it operates in is anywhere between 5 at the low end and 10 at the top end. So if we were just to take their 2030 price to sales guidance, right, of $6.5 billion in revenue, and we give them an average multiple of between that 5 to 10, that implies a future valuation in 2030 of anywhere between 30 and $65 billion in market cap, which does mean that there is some upside to be had right here, right? The market cap right now, currently in the after hours, is going to sit about $13 billion. So if we go with the lower end of the valuation, $30 billion by 2030, just using a normalized price to sales, that would mean that you're going to be having slightly better than a 2x. If the street gives them the top end of the valuation, or at any point during this range, you would obviously be looking for a lot more. This would be more in line with a 4x from the current share price. So essentially, the compound annual growth rate of HIMS could be quite good. Short term, it may be very volatile, but the expansion of their product offerings, the expansion of their revenue profile, their customer base, which has a very high retention rate, and just the fact that people seem to like their services could indeed push them to get that 2030 guidance revenue in line and could represent a very decent possibility for some upside in the share price right here. I do have HIMS myself. It's not a very large position. I entered all the way back here at about $27, $28. I recently sold some shares for 2x. I cut my position in half, made the whole position free, and the rest of that position I will be riding for the long-term prospects of the company. But you can see some decent upside here in HIMS, and that's everything that I had for you guys for the HIMS earnings. Hopefully you guys enjoyed. Now, company number 3 is going to be one of my favorite companies in the entire market, but that people very rarely talk about. It's one of my favorite growth companies in all of the tech landscape right now, and that is Mercado Libre. Ticker is MELI. So Mercado Libre coming in with earnings, we know that they dropped from the top earlier in July. The company was currently down 10%, which I've been buying a bit more shares, but I probably will be going shopping tomorrow for a couple more. If you take a look at their earnings release right here, you'll see that from the after hours to where we are right now, company sadly down 6% because they did miss on a few key metrics, but it definitely does not undo from its long-term growth story. This is kind of a bit like Amazon, not for the same reasons, guys, but the same thing that I'm doing with Amazon, which is buying any negative earnings releases from the company. I'll be doing the same thing for Mercado Libre. So let's take a look at some of their numbers. Missed on EPS by 13.6%. Now, this is because of some one-time charges and some capital expenditures that they were doing to expand the business, so I'll allow it. But definitely this was the main contributor to the stock price being down in the after hours. They did beat on revenue, though, by about 1.73%. I'll show you some of the metrics, guys, but just to present this one at a first glance, this company is going to be growing excessively quickly. Look at the difference in EPS. From this year, 2025 to 2028, you're talking about an over 2x, almost 2.5x increase in EPS. And in terms of revenue, look at the revenue this year, 27 billion, 2028, 50 billion. They will almost be 2xing the revenue over the course of the next few years. I still think it's a very attractive opportunity. That being said, let's jump into some of the earnings numbers. So you can see right here that in terms of the revenue numbers, that was up 34% year over year. Very strong. EPS was the pain point for the company where they missed total payment volume because Mercado Libre does two things. They're an e-commerce giant in Latin America, kind of like what Amazon is throughout the rest of the Western world, but they also have a very lucrative fintech arm, which is kind of a combination between, well, there's a buy now, pay later aspect to it, like Affirm. There's some aspects like PayPal that enables peer-to-peer transfers, but there's some aspects like SOFI as well that delve into lending processes and credit card issuance and stuff like that. Their whole fintech arm is a very profitable portion of the business. TPV, total payment volume, 39% year over year. Fantastic for the fintech arm. And gross merchandise volume, that's kind of the e-commerce side of their business, 21% year over year. So fantastic growth numbers by the company, even though they did miss on EPS. If we take a look at some further sales metrics for the business, you'll see that they're growing everything at fantastic clips. The blue bars right here are the commerce revenue from the e-commerce section of their business. Very beautiful expansion. I showed you the future estimates. They're quite good as well. The credit revenue, a new arm of the business, which was started during the pandemic, that is also moving excessively well up and to the right. And the fintech revenue, which is one of their most profitable portions of the business, also up and to the right. Those are the purple columns right there. Let's have a listen to some of the few key highlights from the earnings release here. Here's what the CEO had to say. We are encouraged by the progress we are making towards our long-term goals of being the destination of choice for online e-commerce in Latin America, becoming the region's largest fintech and building the best value proposition for advertisers in branding and search, kind of like Amazon. We took bold steps on all three fronts this quarter. Referencing the money that they spent, which is a reason for the EPS miss, these actions will help us to build greater scale and further enhance customer experience and satisfaction. If you're going to miss EPS, it might as well be because you're growing the business, not because of stock-based compensation or expenses that are out of your control. Here, they're really reinvesting into the business, doing a good thing. We have built the fastest shipping network in Latin America since launching our managed network in 2017. This speed is powered by more than 30 fulfillment centers, which handled 57% of shipments across the region in the second quarter. We are committed to maintaining our competitive advantage in speed, as we are convinced that fast delivery will always be in high demand. Another highlight of the business, this is something that they've just done, and it's going to really drive some of those advertising numbers, which is a profitable segment for the business too. Our integration with Google Ad Manager and AdMob went live in April. This is an important milestone as we seek to build the best value proposition for advertisers in branding as well as in search. In Q2, advertising revenue growth accelerated to 38% year over year, and with the help of Google Ads Manager, they'll probably be able to deliver even more gains for shareholders and for the business as well. They also continue to gain market share across all major geographies in the second quarter, both in fintech and in e-commerce overall. Fantastic earnings report for Mercado Libre, but just getting overshadowed by that miss on EPS, which is very normal. If you take a look at some of their earnings slides, you'll see that GMV, there you go, there's your 21% year-over-year increase. 31% year over year in terms of items sold. Fantastic. Total payment volume, 39% year over year. The credit portfolio, as I showed you right here, the orange bars right there, credit portfolio, 91% year over year. Fantastic, fantastic, fantastic overall. Nothing bad to say. And 7.7% net margins. Now, Mercado Libre, if you look to the downside right here, they were a company that prior, did not have positive net margins. They have scaled those net margins to what they are today. It's still a little bit lumpy. Every quarter varies between 7 and 10%, but this quarter overall was not bad. 7.7% net margins. Let's go into a few more key slides. By the way, their free cash flow was a bit light because they spent a lot of money on CapEx, building out their infrastructure networks, of course, as we previously just saw. Some of your key performance metrics right here: unique active buyers, 25% year-over-year growth. That is fantastic. Talking about the e-commerce portion of their business overall. Solid gross merchandise volume and items sold across the board here, whether that's in Argentina, Brazil, Mexico, and other end markets. Consolidated results: 37% of GMV growth overall, and many markets doing very good. And items sold, same thing, right? 31% consolidated. Fantastic across most of their end markets overall. Marketplace highlights: same and next day shipments, 162 million items, guys. They're getting there, guys, right? 52% of shipments were delivered within the same and next day. So just goes to show you. And it's not easy, not as easy as delivering like Amazon does in Canada and North America, and even in some parts of Europe. The networks in Latin America are a lot more challenging, right? So for them to be able to deliver on these last mile obligations to where 52% of all shipments were done same day or next day, that is really good for the business. That's excessively fast. Items sold per unique buyer, 7.8. That is still good. 5% year over year. Just goes to show that customers are using their platform over and over. And that has been the case now for 2, 3, 4 years in a row. Fintech services highlights: monthly active users was up 30% year over year at 67.6 million, which is a fantastic number for the company. Some of their services highlights: assets under management for that and the credit portfolio. Very strong here, guys, right? Very strong. in terms of assets under management, 109% year over year. And that is across many different landscape here, whether you're talking about consumer, credit cards, merchant services, or asset-backed solutions. Every single metric up and to the right for this company. So everything, guys, e-commerce and fintech, really strong here. Net interest margin after losses, still at a very cool 23%, which is not so bad overall. Acquiring TPV up and to the right, which is a common thing that people look at. But the last one that I'll show you here, guys, is monthly active sellers with credit. 28.4%. So really expanding. They're kind of merging what they have in e-commerce and offering everybody that uses their e-commerce their fintech solutions as well. So there's a very nice synergy going on in the business overall. Other than that, guys, there's not much more to say. A couple other fancy slides, but I think you guys are getting the point by now. This is a company that's really dominating across both landscapes, e-commerce and fintech. And as I've shown you guys, for the next 3-4 years, the growth is not done. They will be expanding EPS in a very solid fashion. They'll be expanding revenue in a very solid fashion. Their balance sheet is also quite good. This is a company that does not have that much debt in relation to the free cash flow and cash on the balance sheet that they have. So of course, they're expanding the business, incurring a bit more debt, but at the same time, they're growing free cash flow, growing their cash position, which is very solid. So right now, as we currently stand on Mercado Libre in the mid 2200s, is the company a buy? Short answer is absolutely. The forward price to earnings here at 22.60 is a 45, but they are growing EPS by 34% year over year through 2027. That gives them a PEG ratio of 1.34. That's a very decent valuation. So there are still fantastic companies growing revenues and EPS by very large amounts that are still fairly priced, right? 1.34 for a PEG, that's a buy from me. Forward price to sales metric is a 4.39. Amazon is a 3, but this company is growing a lot faster than Amazon, and Amazon does not have the fintech arm either. Free cash flow yield at 4% is fairly good. And if I just use a standardized price to sales metric, if we give them an expansion at 5 times price to sales through 2027, they would have an end market cap of possibly 253 billion, right? So this number should say 2028, actually, my bad. The current market cap is 121 billion, meaning you're looking at possibly a 2x over the next 3 calendar years, which is a very strong compound growth rate for a company that's already a large cap, right? So it's rare sometimes to find a large cap that you can clearly say it is a very good chance of 2xing. This company remains a buy from me. I've been an investor in Mercado Libre for a very long time at this point. My first buys were somewhere back here in 2019. They've been growing well ever since, and it remains one of my favorite companies in the market that is outside of the United States. And I don't invest in many companies that are outside of the US, but when you have such a dominant position in 2 very large segments of Latin America, the e-commerce and the fintech divisions, right, I am definitely going to continue to invest my money in this fantastic company. And with that, that wraps up all of your earnings for today. Hopefully you guys enjoyed those. Now let's dive into some charts, shall we? All right, so starting off with our index review, we're going to take a look at the SPY right now, and you guys can see, guys, very nice recovery. However, we are still below this 12 EMA. I was saying pay attention, guys, because we have now lost the 12 EMA overall, which is something we have not done in the last 3 months. The bulls are trying to get it back. We did not lose the daily higher lows, which were down there at about 620. They're trying to get it back, but the lower time frames, we still are going to have to see if the bulls can change back into a nice continuation of the hourly uptrend, claw back some of these losses. The door is still open, guys, for the downside reversal. One of 2 things is going to happen. We're either going to engulf this move as if nothing ever happened, or we are going to roll over. In either case scenario, the logic is very simple, guys. Identify some high quality companies at good support levels for some possible swing trades, and I'll bring some of those up later on in the video. But if you have a long-term portfolio and you're seeking to understand, should you buy the dip? It's always been the same recipe, guys. Every paycheck, 10% of your amount, 10% of your pay should go into long-term, high-quality companies or ETFs. Don't try to time the market too much, right? It is still a decent environment to be taking some profits off the table, as we've been seeing a lot of gains here since the April lows. if you have short-term bets, meaning if you have expiring call options, August, September expiries, you know seasonality is a little bit bumpy, you know the jobs report narrative is probably going to come back. It's very tough to determine whether or not we're just going to moon through the months of August or September or get a little bit of chop, right? Chop or downwards is going to probably kill some of the premium on your call options, so just be diligent on taking profit. But as of right now, the long-term bulls are still in full control of this. The weekly higher lows are attempting to be set at the lows of last week right now. We will only get that confirmation once the bulls eclipse our highs, then we can confidently say the weekly higher lows are set. In the event that you unwind into a daily downtrend for the rest of the week, because it's always a possibility, right? You're probably coming back down here, 612 to about 598, which is the prior all-time high resistance range. It's now going to be support. And then you would just be looking, once again, for a very healthy pullback, looking for a weekly higher low for possible further trend continuation, or maybe just some consolidation at the highs through fall seasonality. I still will be a dip buyer, but not on everything. I'll be looking specifically for companies that have given very good end of year guidance, but maybe their share price has not followed because of their most recent earnings release. Shout out to Amazon, shout out to Mercado Libre, things of that nature, right? Moving on to the QQQs right now, we can clearly see tech was the place to be today. Again, we had lost this 12 EMA right here for the first time in the last 3 months. In the event that you get the rollover, daily downtrend is underway because we know that the short-term bears are still somewhat in control, right? We need to get the hourly uptrend back and we need to recapture these all-time highs. Anything under that, you might just get the lower high. You open up the door, right? The door is still open for the bears right here. So if it happens, don't be surprised. It's very tough to predict these things. The best thing you can do is plan and react for them. So I have a lot of buying power and I'm picking off all of these companies that go red after earnings. If they have unfavorable price action, I am a buyer. I have not liquidated any of my long-term positions, such as, a lot of the leap call options that I have, but a lot of the swing trades that started back here for me, I have been taking profits on them as we move into this fall seasonality and leading into, because I took profits before, right? But since we got the jobs report, you know that you have some ingredients here that could warrant further declines. Doesn't mean you're going to get them, but you do have the ingredients, and that's all you have to know, right? If you unwind right here, well, we're just heading for a bit of a weekly higher low. The bulls do control the weekly time frames, so I wouldn't be too nervous right there. And as we know, institutions have a lot of buying power, smart and dumb money. The chart I showed in the introduction, right? Weekly higher lows could be achieved 540 down to about 510. I know it's a very wide range, but that is possibly where the bulls can find some more price action. The weekly higher lows are right here, 522. So a lot of space for the bulls to work with here, guys. Still a big fan of being a buyer in these markets, but a more calculated buyer rather than just the shotgun approach of buying absolutely anything at every price. Moving on to XLF financials right now. So financials, not a bad day, 0.99% to the upside, but we know that the bears got a lot of control recently, right? Unwinding the entire daily move. So sadly, now that this is the case, you're going to have the two-step process of a reset right there. We'll be seeking to understand if the bulls can do that. In terms of the weekly, which is a bit more clear, right? You know that we're coming back into previous all-time high resistance, which is currently support for the markets. Undercutting on the weekly a little bit, but not losing the overall support range. Now, as of right now, it's very choppy, right? Higher highs, lower lows. You have like an expanding of the range right here. No big control, but if you want to know the clearest time frame of them all, in my opinion, guys, it's the monthly, right? Take a look at consolidation on financials right here, the big tariff sell-off, the very nice engulfing move. If you seek a monthly higher low throughout this month into September, we will still be buyers of financials. The bank earnings were fantastic. The credit card earnings were fantastic. So dips in those different industries, banking and credit cards, all of those dips should be buying. Special shout out to Visa. Visa has not done much of anything in the past 4, 5, 6 months. MasterCard, same concept. These are extended bull flags on the monthly time frame. I will be looking to accumulate because I do believe that these companies, especially with their earnings, will perform very well back half of this year, but also into 2026. Moving on to healthcare right now. Healthcare, 1.43% to the upside. Still not cracking these weekly lows, guys. Pay attention. 130 is the area that you cannot lose. If you lose that, it is going to be the start of another leg of a weekly downtrend. But as of right now, just still holding on for their dear lives right now. The time frame that makes the most sense in my opinion though is the monthly, right? This is just monthly consolidation at the lows right here. Big support from previously, still a monthly downtrend, and we are still looking for signs of life in the healthcare industry. The multiples on some of these healthcare companies are quite cheap right now. I am choosing to play the index overall, accumulating some leap call positions for 2027, because although it can be bumpy in the short term, I think the long term for the healthcare sector is quite clear. They will start participating in the market. It's a question of not if, but a question of when we will be looking for that upside rally. So rather than me picking individual names like NVO or like UNH or like some pharma companies like Merck that are down a lot, I'm just playing the overall index ETF rather than choosing individual names. That is how I'm choosing to play it myself. Moving on to semiconductors right now. Semiconductors coming roaring back today, 2.2%, but we know we cut the lows. So higher highs, lower lows, kind of the same thing as financials, right? So the volatility, what you need to understand when you see that, the volatility right now has expanded. Now the bulls still have a chance of recapturing this as if nothing happened, but eventually they will have to reset the daily uptrend, meaning higher high, higher low, and a clean, smooth pattern. We had lost on Friday the 12 EMA. The bulls have a chance to get it back, but the bears also still have their chance of their own to send us into a daily downtrend if that does happen, because most of you guys are not concerned about the further upside. Most of you guys are probably concerned about the downside, but in all reality, you shouldn't be. And I was very clear about this last week as well. If the event we move down, guys, are coming probably back down here to about 275 on the SMH, which would be a confluence with the prior all-time highs and the 12 EMA right there, but also the SOXX, which shows a bit more clean price action, a bit more clean support, right? This whole area, I'm talking about 235 down to 214, this whole 10% range right there, nice fallback area for the bulls right now. So you will be looking for a weekly higher low for possible further trend continuation. Whether or not they get it right now, that is anybody's guess, right? It's a daily downtrend the bulls have to recapture. What I am doing, though, is selling puts on my favorite companies that have come down. Companies like LRCX. If LRCX dips again, I'll be selling puts down here, low 90s. Micron has been one that I've been targeting for a few weeks in a row right now. Down here, $100 range, very nice. And even other companies, if AMD, NVIDIA, stuff like that pull back, I will gladly be selling puts. I will be buying the dips. Matter of fact, I've been playing a lot of SOXL on these dips. I'm playing small contracts, but I'm playing them below because I do want to buy the dip on the semiconductor landscape. I am still bullish on this industry overall. Moving on to the Russell right now. The Russell having a very nice day of recovery today, 2.25%. Coming out of the support range and clipping the 200-day EMA on Friday, 217 down to 208. Now, the Russell is going to struggle as long as interest rates are not cut, but we know the odds of a September rate cut right now are almost 90%. So now might be the time where people start positioning a bit more aggressively into the Russell, not for short-term gains, but maybe gains into 2026, 2027 as the risk-free rate continues to drop. As we see right now, not bad performance. The weekly higher lows are probably established right now, and we are maybe looking to make a move, another move into resistance. If ever the market rolls over, you'll once again just be looking for the fallback zone. Not a bad time to position in the Russell overall, especially if your timeline is like 2026 and 2027. It can be bumpy in the near term. You have some seasonality. Yields are still relatively high, but as they come down throughout the rest of the year into 2026 and 2027, this sector should see more and more money rotation. That's everything I had for you guys for your major sector recap. Hopefully you guys enjoyed that. Taking a look at the VIX. The VIX down 14%, right? So some of you guys were anticipating follow through and continuation from the VIX, but unfortunately, guys, it just didn't happen today, right? If the uncertainty does not continue and we get a nice green day, well, the VIX is just going to come right back down, which is why it's so hard to play the VIX, guys. If you're looking for big expansion, you need continued uncertainty. You need them to build the narrative. And so far with today's gains, there wasn't much news today, but they've unwound this narrative right away. I guess the market is kind of pricing in the fact that they're going to have more rate cuts, which kind of undoes some uncertainty. As I said, the labor numbers were not that bad. The net new jobs that were added were kind of weak, but the unemployment rate is still low. Companies are not firing people by the millions. And additionally, there's still a lot of jobs that are open in the economy, 7.5 million jobs. So it's very tough to build a narrative surrounding the fact that the entire labor market is imploding. Is it slowing down? Yes. And a macro catalyst like we got on Friday will have an uptick in volatility. But if you cannot sustain that uncertainty, the VIX will come back down. So it's been some very nice few days here of being able to sell some options, right? Either covered calls or basically selling puts under the market. And now we're coming down again. We will see if over the next few days we get some other news catalysts or whatnot. Maybe you can see a rise, but I also would not be surprised, guys, if earnings continue to come in good, because we know this market moves on earnings a lot. Yeah, it can move on some short-term headlines, some short-term narratives, but as long as earnings are very strong, guys, it's very tough to paint the picture of an economy that's rolling over right now. Onto the dollar is still hovering around the $98, $99 range. No progression there in terms of the trend. The bulls are trying their best to recover the weekly, trying their best to get a little bit of monthly momentum going, but the dollar still remains a bit weak. It's a very complex trade overall. I bring it up just because of the currency tailwinds that some companies can report. Now that we're through earnings, though, you've seen a lot of positive net FX impacts for some companies, especially the big tech players, companies like Visa and MasterCard. So just keep that in mind for the dollar. But I think my analysis of the dollar is probably going to stop because not many of you are even trading this one to begin with. Yields, longer term yields, the 10 and the 20-year yields, although they had a slight uptick today, the pattern is very clear here, guys, right? Excuse me, on the Monday they were down. This is now the Tuesday candle since I'm recording this a bit late at night. Sorry for the late upload, by the way, guys. Had a couple things to take care of today after the market close. That being said, yields down. Very nice, guys. We're starting to break below the area that I've wanted to see us break below since April. Weekly downtrend, monthly also looking to cut these monthly lows. 4.2, give me some more candle closes. You're probably going to start to see a trend. Now the bond vigilantes will cool down. What they don't want to see is the Fed cutting rates into a very hot and booming economy. That will make the yields skyrocket because the bond traders will believe that the Fed's just not cutting interest rates for the right reasons. But if you cut them on a slowing of the labor market, then you can kind of get behind that thesis overall. 20-year yields also showing some signs of cooling off right now. 4.76. Give me a break below 4.7 for the weekly downtrend and the start possibly of the monthly rollover. We've been high for so long, but maybe is now finally the chance even for our bond trade to start expanding, which is why I've been saying, guys, we were waiting for this, right? TLT has been in an accumulation phase now for the better part of the last 2-3 months at the lows here. You might just be able to see some of that weekly expansion as we move closer and closer to the September rate cut and then get them. This bond trade is still a very attractive trade, but it's going to be a slow moving trade, so keep that in mind. Moving into gold right now. So gold on the Monday session had a nice positive day of follow through here, not coming back down. And overall, there's a bit of a lack of control on this chart. It was a daily uptrend. The bears engulfed the move. The bulls are trying to make a push, and this is a very nice push on the fibs here, guys. Talking about a almost over 618 retracement size. It gives the bulls the opportunity of resetting the daily uptrend that they lost back here, but still, we are in a range, and we've been in a range, guys, since the month of June. Now, we are trying to consolidate at the highs. If you just look at this weekly, right, it's a tightening up of the weekly range. That, in other words, is and has been a bull flag holding on the 12 EMA. So you wouldn't be surprised, right? All the focus was on these lows, 32.50. We were saying if you get a break and close below, probably you're going to get the downswing, right, on gold. But as of right now, that's not happening. We are still overbought conditions right now. Price action could lead us to the upside. But overall, guys, it's kind of overbought conditions for gold right now. It has been. You can see some expansion, but are we going to be able to see $4,000 this year? Maybe not, but it is a very nice bull flag for some extension into 3,500. I'm not positioning in gold myself personally. Moving on to Bitcoin right now. So we know that Bitcoin, as of last week, also flushed the lows. Daily downtrend, possibly looking for a lower high. A lot of resistance right now at the 116 range and below our short-term EMAs. In the event that you roll over a bit further and continue the daily downtrend, which I assume is what some people are nervous about, what are you looking for here, guys? A higher low. Anything above 98 looking for a higher low? For possible further trend continuation, a few key areas to consider. 107 down to about 99. That is the most relevant area of price action, the prior all-time highs. You could see the bulls find a lot of support down here before maybe going for another leg. And this is also where I will be looking to accumulate more Bitcoin. As of right now, the way that we can do that is on red days, we can sell some put options either on your favorite ETFs, whether that's IBIT for the 1x exposure down here into the 6160 area, which is your previous all-time highs. As you can see, it's literally the chart of Bitcoin, or even BITX, the 2 times leverage version of it. That would have to be some of the lower 50 range. So I like Bitcoin for a swing trade higher, but I'll be patient. And if not, I'll just keep selling my puts down there. Moving on to our big tech names right now. So first things first, moving on into Apple. Apple was actually up 0.5% on the day. A lot of that recovery was had into the end of the day. They opened higher 2%, got some India news overall. The fact that, Trump was considering possibly increasing tariffs on India because of their ties to Russia. And of course, because we know that Apple shifted some of its production to India in the most recent few quarters, it was affected by that news. The clearest time frame for me, considering the fact that we had earnings, guys, is still the weekly time frame. Very nice support down here for Apple, talking about 200 down to 195. I think Apple is a decent buy the dip opportunity. Don't forget that Apple is lagging behind its sector peers by a wide margin right now, 19% down on the year so far. I think there's some good risk reward in this trade, and I will be looking for the expansion of Apple over the next few quarters with the expansion of the market into 2026. As a result, I have some leap call options, and I will be building those leap call positions a bit further if we move down into the 190s. Their earnings are pretty good, showing 10% revenue growth year over year, which was their best quarter since December of 2021. And they also have a lot of nice products on the horizon. The iPhone 17, which is a refresh in terms of design, and a lot of very nice new specs. I think that Apple is kind of well positioned here. Short term may be bumpy, but I think the long term is a clear possible nice risk reward for the upside for the company. On to AMD. Well, there's not too much to say about AMD because they will be having earnings tomorrow. The expected move for earnings on AMD is 8%. I am very curious to see what they're going to say for earnings. I think they're going to crush it. Whether the market gives them a nice little bump after earnings or not, that obviously is the casino, right? But I'm pretty sure they'll absolutely crush their numbers. 7% to the downside, guys, after earnings will put you right back down here into the low 160s. And of course, 7% to the upside would put you above the resistance range at around the 190 mark. In terms of the weekly, which is the clearest time frame right now, you're sitting into resistance, 184 down to 170. If they smash through it, guys, another breakout and possibly retest. So you will probably want to play the breakout of earnings, retest of this. This might be an opportunity for some swing trade longs. If they falter, though, and come back down here to the 160 range or 150s, that will just be looking for a weekly higher low. And I will be buying those dips as well on AMD. I have my positions for now, but if we do come down, guys, probably a decent candidate for some leap call options. Yes, even after this rally, guys, they're currently sitting at a very fair valuation, and the thesis for AMD is not done. My price target for the stock is roughly sitting in the mid 200s for next year and $300 in 2027. Fantastic EPS ramp, fantastic revenue ramp. The thesis is fully intact for AMD. We know they have a lot of pricing power. They just increased the prices of their GPUs for data centers by 70%. And even in spite of that, it is still under the price of similar NVIDIA Blackwell units for arguably the same performance. So I think AMD is still going to be one of the hottest stocks, at least in the next 1.5 years. On to Amazon right now. So Amazon, continuing to struggle. But this is a question of, Amazon, if you just look for the past few quarters, right? Now, if you take a look at this quarter right here, in May, you can see that, yes, coming off the lows, Amazon did rally after earnings. But prior to that, a lot of quarters, guys, Amazon reported strong numbers, came down after this quarterly earnings. Strong numbers right here. Unfortunately, the stock after that, the stock after that was up, but did have a bit of short-term volatility in it. Right here, right in the August quarter, stock came down like 8%. In the past quarter here, also the stock did come down. Earnings have been very volatile for Amazon, but the direction of the business is very clear. A lot of the emphasis on earnings, guys, was their operating margins were not as fantastic because they chose to spend more money on the business to expand several different things. We covered it on the channel. And the AWS growth, right? Only coming in at 17, 18%, whereas Google and Microsoft were showing over 30. Yeah, but they're the industry leader, guys, right? It's the law of large numbers. Still, for them to grow their AWS business 17, 18%, objectively speaking, those are very strong numbers. Amazon, for me, there's no other way around it. It is a buy, even on consolidation. But that being said, clear loss of the daily uptrend right now. So, and also clear loss of the support range, which we were above, which is now resistance, 228 to 218. It might take the bulls a while, right? Even if we backtest this resistance area, might take them a while to regain momentum and reset the daily uptrend, which is now lost. Essentially, what we're in right now is weekly consolidation. Weekly higher lows are 207.35. If you lose 207.35, you will also lose the weekly uptrend. But have no fear, guys. This is just monthly consolidation. When in doubt, zoom out, and the monthly time frame shows a clear trend right here. We are just trying to set some higher lows to possibly expand. Amazon's still one of my favorite plays. So believe me when I say, if we come down to lower 200s, close to this support area, I will be buying more shares. I'm currently selling some put options down here. And also I might be positioning, if we come down there, I'll be positioning for more leap call options with a 2027 expiry. Fantastic company all across the board. Just a little bit of an overreaction for earnings, in my opinion. Google up 3% on the day. Fantastic day for Google. So we were noticing last week, they kind of lost the daily uptrend. We were going into a bit of weekly consolidation. It seemed as though, as of Friday, we were prepared for a bit more, but the bulls said no. So as of right now, no consolidation has been started. The clearest time frame here is still the weekly. Full control of this weekly, continuing to expand to the upside, looking very strong right now and reclaiming the 12 EMA and not losing the support area, guys. 195 down to 187 is the support range. But I know what you're saying. What happens if we unwind here over the next few weeks with the Department of Justice lawsuit and their final ruling? If we somehow fall off on Google, I will be a buyer back down here in the 180s, possibly adding to my leap call positions, definitely adding to my long-term shares. At 190 right now, the valuation of Google is very good. We covered their earnings on the channel a few short weeks ago. All aspects of the business were performing very well. And no, their search market is not currently being disrupted in a meaningful way by other large language models such as ChatGPT, or you would see significant declines in search, something we have not seen just yet. So that narrative is being undone one quarter at a time. Very nice performance by Google. On to Meta right now. Meta up 3.51%. Not a bad day for them. And they had tremendous earnings last week that we knew. Bit of consolidation after earnings and now moving higher. So your daily higher lows are definitely set right now at about 744. If you lose this without setting new highs, daily downtrend, but just very healthy consolidation, you would just be looking for a weekly higher low, tons of space, anything above 694 on Meta, looking for that higher low, maybe a back test of 740. If we back test 740 over the next few weeks, talking about these guys and fill the earnings gap, probably a swing trade opportunity for me. You'd be able to set a stop loss below there and then target all-time high further breakout levels such as 800 and 850 psychological. No trades for me on Meta right now. I have all the Meta shares that I want. In terms of swing trades as well, it's a bit too extended currently, but even adding to the position, we commented on this after earnings, guys. The valuation is not so bad, and with the forward prospects of Meta going probably to $1,000 over the next year and a half's worth of time, I would not be surprised if all buys here are rewarded. It's just, I'm not going all in Meta up here, but adding some shares up here, not the worst proposition. On to Microsoft right now, recovering a bit after their earnings, so very awkward price action right now, big decline after earnings, but the bulls are still largely in control of this chart right here. Beautiful daily uptrend simply continues at this point. Higher lows are trying to be established right now at 520. If you move the lower high into lower low, unwind of the uptrend, unwind of the 12 EMA as well, then you just might be heading into a bit of weekly consolidation. We'll see if that's the case, but so far Microsoft has been straight up, no signs of showing down. Just look for the Netflix effect, right? You saw what happened to Netflix. Eventually they do roll over the daily, they do lose the 12, and they do go into weekly consolidation. This rally will not last forever. You're kind of on borrowed time right now. The fundamentals, though, excessively strong. The monthly, however, very far from the 12 EMA. Extremely hard for me to position in Microsoft here for some long-term shares or some swing trades. So this one, not front and center on my list. Moving on to Netflix right now, up about 1%, but we know that Netflix has been trapped in this daily downtrend for a while now. Rejection from resistance again, talking about 1217 to 1185. We will see when this one stops, and it will only stop when the bulls engulf a move and reset the daily uptrend. That being said, we're not very close to daily oversold conditions. The MACD is starting to want to curl. So that being said, if the SPY and QQQ unwind all of Friday's losses and move higher, you would not be surprised that Netflix does rejoin the party with the bulls. But so far, no indication of that just yet. Weekly, right, consolidation for this stock, loss of the uptrend, but not a downtrend. That will be lower high into lower low. As of right now, Netflix for me, it's not a buy quite yet. If I see some further erosion into $1,100 close to this monthly 12 EMA, I think it would be more manageable. The valuation as well would be more manageable. It's at the top end of the range right now. So although I'm very happy as a Netflix shareholder, I will only be adding to some shares if we go down to $1,100 to $1,000. On to NVIDIA right now. NVIDIA, 3.6%. Stock cannot be stopped. Even one day is not enough, but we know they never lost the trend. They never even lost the 12 EMA on Friday, guys. And we were commenting on that, right? So the NVIDIA party continues right now. In the event we cannot break new highs and move lower than Friday's close, 170. That would be a daily downtrend, loss of the 12. And you guys know the drill. You're heading into weekly consolidation, healthy weekly consolidation at that. 12 EMA is right down there at about 158. And below, we start our very large area of support, which starts at 150. I mean, there's a couple levels here, but I made a larger box just so you guys can understand. The first stop, obviously, is 150 down to 140, let's call it. So that top end of the range would be something that I would be targeting in the event, I'm not saying it's going to happen, but if it does happen, I will be loading up some more swing trade buys for some NVIDIA down there. But fantastic performance by this company. And they have their earnings coming up in a few weeks. At 170, the valuation isn't crazy. Definitely not as crazy as Palantir, right? A 1.7 peg. Not terrible. Price to sales is a little bit hot right now. I think AMD dollar for dollar is a better bet in terms of the upside that it can get in a fast amount of time. Moving on to Tesla right now. Tesla up 2.19%, but Tesla doing a whole lot of nothing. Still in the confines of this weekly tightening range. So I know a lot of you guys have been having fun selling some put options down here into Tesla, into the support region. That's fine. Just don't go in with too heavy exposure right there. But the one thing you're noticing here is the daily downtrend. You'll look for the bulls to recapture this. Overall, guys, we can talk about short-term trends, but the weekly is the clearest time frame for me. Tightening range right now. Keep a close eye on 291. If you break that, it's a weekly downtrend, and you might just be going for more monthly consolidation. Very wide range right here on Tesla. If you're a long-term bull, then you got to focus on the long-term valuation of the company. Short-term price action is probably not going to impact you. If you only have a short-sighted view of Tesla, then you would find the company slightly expensive right now, and as a result, may not feel the need to play it. But there is a bit of a trade opportunity here, guys. 290 would be a stop loss. The longs are here, and you would be going for an expansion leg into 340, 360. The risk reward overall, guys, is not too bad on that type of swing trade right there, right? Not too bad at all. Talking about a 2-to-1 risk to reward for any short-term trades, but keep them small. Moving on to Palantir right now, we just covered them for earnings, but of course we know that right now they're trading at around 165. Next stop for Palantir, guys, well, psychological numbers, 170, 180, $2,000 per share, right? Overall, though, guys, fantastic earnings. The bulls are still in control of this one. Higher lows are set at the lows of Friday, 150. So any move lower, looking for a higher low to continue the trend. Now, eventually, you might lose this one and go into daily downtrend, but that's not the case just yet. And if that does happen, you know what's going to be the result, right? Just looking for a weekly higher low, anything above 128, looking for a higher low for possible further trend continuation. No swing trades on me for Palantir right now. I think there's, well, in terms of short-term opportunities for some rapid upside gains, I think there's better opportunities out there. As a long-term shareholder of Palantir myself, I am currently offloading a couple more shares, 100 more shares. I'll be keeping 300 shares for the long term, but no more than that. Moving on to SOFI right now. SOFI up 2.73%. SOFI bulls doing a great job here of trying to defend this 12 EMA, which is your short-term momentum guide. Very, very choppy and wide. One thing's for sure, though, if you cut 20.45, that is a daily downtrend, and you are going into a bit of weekly consolidation. The bulls have been doing a great job here of consolidating after earnings. In the event that you do not consolidate to the downside and just move higher, you'll be trying to attack the resistance range 24.5 to 22.5. We covered their earnings last week, guys. If you are a long-term bull in SOFI, there's a very good expansion thesis here for up to $30 per share. Maybe not right away, but over the next 1.5 years, it is a possible likely scenario. That being said, if we do drop off a little bit here with overall market consolidation, I will be a further buyer of SOFI, 18 down to $17, and that is also an area where I enjoy selling some puts. On to Uber right now. Well, it's going to be tough to derive Uber's short-term price action. Why? Well, because they have earnings on Wednesday morning. Expected move on Uber after earnings is about 7%. They have a good quarter and they blow it out. You'll probably be looking up back up here at about $94, $95 for 7%. To the downside, though, you might be looking back to 81. So I'll be waiting for their earnings to be released. I am a long-term shareholder of Uber. My cost is a lot lower, though. The last time that I bought was down here in the low 60s when the valuation made, it's not that it made more sense, but it was just cheaper, right? At $83 roughly, you're not too bad. So in the event we have a bit of an earnings sell-off, I will be buying a bit more shares and maybe even positioning for some swing trades as well, but I will not be positioning before earnings. I think they'll have a pretty good quarter. A lot of emphasis is going to be put on the robo-taxi competition, of course. And lastly, TSM, guys. TSM up 1.61% overall. The bulls doing a great job, too, of defending these levels. No daily downtrend just yet. Protecting this 232 low. no daily downtrend. Although they have lost the 12, they're trying to get it back. If you do break down below there, it is a daily downtrend, and it is a bit of very healthy weekly consolidation, which could see us come back down to the 12 EMA and the previous all-time highs, which are currently 220. The bigger support range, I will admit, is down here 211 to 200. But if I see some sell-offs on TSM in the next few weeks for XYZ reason, guys, I will be looking for some swing trades around that level, going for a weekly higher low for further trend continuation at the all-time highs or close to them right now at around 240. Is the stock a good buy? For the long term, the answer is yes. The valuation is still quite manageable. So this one kind of like Mercado Libre, right? Two stocks that are at their all-time highs, two stocks with very good qualities, and two stocks that, even though they're at their all-time highs, are objectively speaking not that expensive. So don't always get fooled by the share price, guys. Just because something is at all-time highs doesn't necessarily mean that it's expensive, especially if you're going into it with a 3 to 5+ year time horizon. And with that being said, that's everything I had for you guys for our market rundown. Hopefully you enjoyed that. Now, in terms of the biggest gainers and losers of the day, of course, we got to talk about Figma, unfortunately unwinding the entirety of the IPO pop. And I was telling people, guys, to be careful with that. I was kind of non-financial advising people to take profit if they had some very nice gains. The valuation was just way, way, way out of hand, guys. Even now at $60 billion, they have $1 billion in revenue for a year. That's 60 times price to sales. I'm all for fast growing companies, guys, but eventually you have to draw the line somewhere. If you ask me where I might be interested on Figma, you're not going to like the price that I'm going to tell you, but $40, I would not mind. We'll see if they add more option prices to the options chain. As of today, they only had $70 strikes. So I was looking at some short puts, but even 70, I'm not that interested. But if Wall Street adds some more strikes to the downside, I might just be playing some short puts on this one. IPOs and the volatility associated with them have presented me some fantastic profits over the past 2 months. I've played CoreWeave so many times with short puts on this decline right here, coming from the bullish valuations. I've played it so many times, I have not been assigned once. I've played Circle so many times on these various declines and not been assigned once because there's so much volatility. Matter of fact, even today, you could find some juicy short puts in the low 130s on Circle. So Figma, I'll be trying to do the same thing, right? In terms of just selling puts below the market. It's tough. There's no price action, guys. It's very tough to know when this one is going to stop. But for me, the valuation becomes a bit more manageable, around $50, $40 per share. I know that it might not get there. I know that some people won't want to hear that. I love the company and I love their business model, but that's just what I want to pay. On Semi, guys, this is another semiconductor company that has not benefited from that data center ramp, because they don't do much of it, right? You could talk about TXN, which has been down recently. You can talk about even some other companies like, some other semiconductor chips that are more in line with the consumer electronics portion of the business, right? So not all semiconductor companies have been performing equally over the past 1 month. I mean, I could show you some of them here, right? Just so you guys get a better sense of this. It's been the NVIDIA, Broadcom, AMD show right now, right? But look at all these other semiconductors. Qualcomm, Micron's been down, ADI, NXPI, which had their earnings a few weeks ago, now On Semi, and even Skyworks. So if you're not data center focused right now, sadly, the rest of the industry has been lagging behind. And the same thing for On Semi, we've been looking now for several quarters. When is this business going to turn around? When are they going to give good guidance for the auto industry and personal electronics industry as well? You've been noticing it's a very cyclical business because it's too much tied to the consumer. Consumers bought everything that they wanted to buy in 2021 and 2022 with low financing rates and stimulus checks, personal electronics, automobiles. And for now, guys, it's still not coming back. That's why EPS is not coming back. Also why revenue is not coming back. So don't wonder why that aspect of semis is down. I'm still not playing that aspect of semis. I'll play TSM, I'll play AMD, I'll play NVIDIA, and I'll play Broadcom on some pullbacks. But so far, I'm not positioning onto the more consumer-centric focused portion of the semiconductor market. Berkshire coming down 2.9%. I know what a lot of you are saying is, you've been saying this one is a buy, but it keeps dropping. This is true. It is still a buy, guys. But everything goes through a bit of seasonality, right? And a bit of cyclicality as well. Now, Berkshire, they came out with their earnings throughout the weekend. there's a couple pain points. Kraft Heinz winding down a lot of that position, taking a hit on that one too. Insurance also saw rising claims and rising costs as well. As we saw, guys, a lot of the insurance companies, right? And Berkshire is a big one. Look at PGR. PGR has just been down for the last couple of months. Allstate has just been flat or doing nothing for the last few months. Brown Corporation has just been down for the last 3-4 months. And even Chubb, right? In terms of the biggest insurance companies, they've been down and doing nothing for the last few months. So Berkshire, some of their industries consolidating right now, but it is, in my opinion, still a buy. Warren Buffett has still not deployed the cash, but we know he's not looking for publicly traded companies anymore. They are very clear on that at their last quarterly shareholder meeting, which was about a couple months back at that point when he said he was going to step down, right? They want to buy wholly owned businesses in the energy landscape. They're going to use a lot of the cash that they have not to buy other stocks, no, to expand their energy infrastructure. Why? Because Warren Buffett has long-term visions, right? He knows that over the next 5-10 years, energy is going to be the place to be. So that cash pile is not reserved to buy the dips on companies. That cash pile is reserved for either land or buying energy businesses. Buy in terms of bulk buys, right? So those are the ones that they're focusing on and what the new incoming CEO is going to do as well. It is still a buy for me. Bottom end of support right now. 440 is your next stop with the 26 EMA. Historically speaking, guys, right? The 12 is your first entry because usually they do tend to find some stops on the 12 EMAs unless you're during COVID or unless you're in a bear market of 2022. You can see here, 12 EMA. The second time, you go back in history and tell me, since 2011, is it a good time buying Berkshire both at the 12 and or 26? The answer is yes. So stop being impatient with Berkshire. It's a long-term play. It's not a growth company. And whenever this company is selling off by about, 15 to roughly 18% and the SPY is going up, there is some big divergence and we want to capitalize on that. So short-term plays could be a bit painful, right? But the long-term vision for Berkshire is still clear. Even without Warren Buffett, the company will do just fine in my humble opinion. Adobe, I'll be curious to see, guys, if Adobe is going to be able to do anything after their earnings. They've been doing so good on all their earnings, guys. This is a sentiment sell-off, right? It's the fact that AI is eating their lunch. Companies like Figma, other companies as well, generative AI. I will not position on this company any further until I hear from their earnings, which will be in the month of September. As of right now, it is sentiment focused. The valuation of Adobe is very cheap right now. Very, very cheap. But all that being said, guys, it doesn't matter. The sentiment is just too poor. We're coming into our last line of defense right here, which is kind of like the 340. Below that, you're coming all the way back down here to 300. Valuation is good, though. Those are just a few companies that were dropping. FICO, still a great buy for a long-term portfolio. 14.13 all the way down to 12.11. Nibbles and nibbles and nibbles in this location. Fantastic company, just unwinding a lot of that valuation down there. And even Palo Alto Networks. This is a company that I said last week and on the top 5 options play, guys. 160s on Palo Alto, juicy in my opinion. Some of the tariff fear lows, some of the lows from last September. Company's been improving fundamentals recently, has been doing a whole lot of nothing. I mean, it was trying to expand further, but look at this monthly range, guys, right? Wide monthly range of consolidation. Palo Alto has a very bright future ahead of it. And if I can find some 160 buys, could be a very attractive opportunity. In terms of stocks that were having huge moves to the upside right now, Open Door, they have earnings tomorrow. Affirm is one of my favorite plays, guys, in a 26 and 27. Declines in rates and also the consumer possibly coming back. They have a very strong business model. We are looking for the monthly expansion, and today we're trying to go for the weekly breakout. I'd been saying consolidation on this stock was good. I bought it back here with some leap call options. We're now up almost 2x on those leap calls. It is still relatively early on Affirm, in my humble opinion. The valuation now is not that commanding. This could be one of the more favorite growth plays. No recession, and the consumer gets stronger over the next 1 to 2 years, guys. This play is going to do very, very well, in my humble opinion. Then we have some smaller ones like Applied Digital. Applied Digital is not too bad. I really enjoyed their earnings that they had last week. We didn't cover them on the channel, but looking very good for some expansion here. It's a bit of a lottery bet. I mean, they're doing good. They're especially well positioned here for the narrative at hand. We're looking for further price targets, obviously, of $15, maybe up to $20. There is still some meat on the bone, but I would just invest a small amount of money here. We are late, I will admit. We are, well, not we, I mean, I'm not in this one, but if we were trying to position, we are a bit late. The true entry was here, $9 to $8 range. We'd been talking about it a while back there, and now the play is running. So no entries for me at this current time. Symbiotic, same concept. We kind of, we're kind of not in this one right now. So resistance range coming up, all-time highs. Still, I mean, we'll try to do, because Symbotic has earnings this week, guys. I'll try to cover it for you. I'll give you the valuation, but the valuation right now is quite expensive at $56, even though they're growing the business very well. And then you have other thematic plays, right? Restoration Hardware. Restoration Hardware, the valuation, I mean, I'll do it again because they have earnings coming up soon, but at 216, it's not bad. This is the whole home builders / interest rates coming down. Furniture companies could do well. This is a lottery play for me. I have a couple of shares of Restoration Hardware. It's a lottery play. Once again, the theme of the consumer coming back. There's a few ways you can play that. You can play it with names like Rocket Mortgage for mortgages. You can play it with names of Restoration Hardware for consumer segments like furniture and stuff like that. Not a bad opportunity overall. Reddit, we cover them after earnings. Fantastic expansion. No swing trades for me, but I was saying, you know, looking for a 2 to 3 year swing trade on Reddit, even buying some shares here, not the worst proposition. But if we unwind and come back down below there, that would be like a swing trade for me. Call debit spreads, shorter term call options. But for now, just long-term shares. Those are just a few of the companies that I wanted to cover. Obviously, there's many more, guys. I mean, you know, Robinhood, you guys know the drill on that one. Fantastic company, but it's a whole. Toast has earnings this week. Shopify has earnings this week. Tempest AI has earnings this week. So rather than cover Trade Desk has earnings this week. App11 has earnings this week. So rather than cover a whole bunch of companies that have earnings and try to predict what they're going to do, I'll give you those estimates after the earnings come out. Hopefully you guys enjoyed that overall. Now, in terms of the portfolio, lastly, I'll try to wrap this up quickly. The only new trade that I took today, since the markets were very green today, was a short put play. I actually took Apple into the end of the day, getting the 197.5 puts, which was on the top 5 options video yesterday, and we got them for $1.35. Very happy with that Apple position. I was saying that anything under 200 on Apple would be good enough for me to write some short puts. Other than that, guys, it's just been a whole bunch of covered call farming. Now, we did get assigned on a few positions, namely our newest assignment is Amazon. And this is why I tell you guys to kind of avoid earnings plays if you're not convinced or if you don't have high conviction in a company. I played Amazon for earnings. I was a bit aggressive with the strike, 220 into support, expecting some decent earnings, but the market did not agree. As a result, I have some assignments. So you may remember we have a few assignments ongoing right now. We have Amazon at 220, but we did get some very good short put credit premium for them when we got into it, $1.70. Today I wrote some covered calls for $2.74, which gives me a break-even price of $215.56. I'm very happy with this position, even though I am assigned, and I will be making the most out of this assignment and try to milk it for all it's worth. So those are the 100 shares of Amazon that I have in the portfolio right now, with an average cost roughly of $215. In other news, our other assignments, well, the main ones, I won't talk about Open Door, that's just a meme trade. Chewy, we also did some covered calls last week for 60 cents in credit. Our average cost after being assigned on Chewy for 37 is now 36.22. You can see that Chewy right now is trading at about $35.90. So we're not underwater too much. I'll just keep farming the covered calls. Covered calls are right down here, as you can see. We did a great job of farming. They're doing their job. And Fiserv, good old Fiserv, we got assigned at 146 after earnings as well, which is why I tell you guys, if you can't withstand the volatility, just don't play earnings. You can do very well just not playing earnings. Matter of fact, several of these assignments, Fiserv and now Amazon, are assignments after earnings, are assignments before from plays that I took before earnings, right? So if you just want to avoid earnings, you can, right? Sometimes it helps increase the overall return of the portfolio per year. I do have a very decent success rate with earnings overall. I mean, you could tell from the weekly recaps here, most of all these earnings trades result in decent wins, couple losses here and there, and a couple assignments. But I mean, if you go back this earnings season, you'll notice more wins than losses. So it can go either way, right? But if you look at last season as well, last week was quite good. Last season was quite good for us. If I go back all the way into May type of thing, right? Some lottery positions on some earnings here, earnings positions. You know, when you go back here, some of the times we do really, really well on these earnings plays. So they can go either way. I never recommend anybody play earnings, but if you do play earnings, expect to be assigned more often than if you don't play them, right? So that's just a disclaimer, right? Essentially, don't do what I do. If you can't withstand the volatility, you'll just do fine in the case that you don't, right? So those are the couple of assignments right here. Fiserv, we rolled the covered calls down to some 140s. I'm playing some defense on Fiserv right now, just because I understand there's a very real possibility that we're kind of in between support right now, and we can go down to the 120s. This stock, we covered it after earnings. It is a buy from me, guys. 140 is a very attractive price for this company. It's currently down from the all-time highs. 42%, but also the valuation, objectively speaking, is good. But I'd be lying if I said there isn't a real possibility of coming down to 120. I might dollar cost average if we come down there, but for now, I'm just playing some defensive covered calls. If you want to see my average cost on this position, after a couple covered call positions right now, 142.12. So we're down about 600 bucks. Not that bad right now. We'll see if we can manage this assignment properly, but I might be stuck in this one for the next few weeks type of thing, right? Depending on market conditions. Long calls are still maintained, haven't changed anything there. You can see the Affirm call right now is up 2x. KWeb still in motion. Rocket Mortgage, we closed one of these for 2x. The other batch is up 120%. We have the XLV contract as well, which is still underwater, but I might be adding to this contract soon. And then you have the short put plays that are still underway for this week, some of which I didn't show you because I didn't talk to you guys about these last week, right? Apple is for the trade from today. The Amazon covered calls, the Chewy covered calls, the Fiserv covered calls, we just went over those. HIMS, I took a short put play before earnings. 41 strike for 20 cents. We got 0.5% for 37% away on HIMS. Just goes to show that sometimes you don't have to play earnings too close to get some decent ROI. That position will probably be worthless tomorrow, so we've made a nice little win there. New holdings, $12 put. It was in last week's top 5 options. Not this week, last week. $12 short put. We'll see if we get a sign. Open door, that's just a meme play. We were running some covered calls. They have earnings tomorrow. Sentinel-1, 17.5 short put. We're currently up on this one, but I like Sentinel-1 down here, guys. I was talking about it for small accounts, right? $17, $16 range, bottom of support. Might just be a buyout target for other cybersecurity companies. The business is doing well. And then we have an SOXL that we did last week for about 27 cents, which is over 1% per week, 1.5% to be exact. And we are currently profitable on that trade as well. So you can see I have some small wheel trades, some assignments, and then an Apple big position. I'll be looking for more earnings trades for this week, either before or after earnings, but I never recommend you guys play before. So for the most part, I'll also be looking for after earnings. If you get some big declines like Amazon, I'll be looking to play some of these trades, the growth companies after earnings, and some of our combination trades here, guys. I mean, we've closed all the profitable ones. The only ones are the ones that are just lagging behind, right? Talking about Adobe, ASML. ASML just kind of died after earnings. This is a play I took leading into earnings, for a bullish expansion play. But you can see the call debit spreads here, even though they're down, like Fiserv was a call debit spread into earnings. That one is pretty much dead, right? CRM is still alive. We're not down. I mean, we're down about 60% on that one, but all of these have until October. So we'll see what happens. But as you can see, they're very small. We made a lot of money on debit spreads this year. These are just a few of the ones that are kind of lagging behind, just not performing. We have until October to make our final decision on, whether or not they end up pretty much worthless or not. But overall, guys, the bigger trades, the leap call options, all the other trades for call debit spreads this year have largely made up for these losses. But the plays that I put most of the money in, guys, are the leaps, the high conviction leaps, right? You can see some of them up here. They're performing really well, but the bigger ones, right? The Amazon bull call debit spread here for 2027, the Google bull call debit spread leap for June of 2027, that's up 51%. The Micron leap call debit spread here, that is still up over 100%. And we have so much time on these. So all of these larger call option plays with a lot of time, they make up for any mishaps for the short-term ones. But all the short-term ones, I've wound them down. These are just the ones that are left, right? You might remember I used to have like 10, 12 of these running at the same time. There's only about 4 or 5 of them left. I won't be adding any more short-term swing trades for the moment. Until maybe we get some further declines in the market and move through this seasonal pattern that we're having. So that's everything I had for you guys today. Hopefully you guys enjoyed. If you did enjoy, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing if you're new. We do these every Monday to Friday after the close. And last but not least, if you have any questions, feel free to reach out down below in the comment section. I always enjoy reading your guys' comments. In the event you wanted to join our trading and investing community where we trade the markets every day, but also build very high quality, long-term portfolios, the link to the Discord is down below in the video description. Yes, you get access to every single one of my trades, whether it's the wheel strategy trades, the call debit spreads, the leap call contracts, the swing trades with shares. I mean, I'll just go over, these are the last 2 months, 3 months worth of trades, right? The green check marks are wins. The red little circles are losses. It's normal to have losses, but if you can be consistent and the wins outweigh all of the losses, the accounts will be doing quite well. So those are just a few of the trades. You get access to all of them as part of the Discord. You get access to our private morning live streams, Monday to Friday, where I trade the markets live for for 2-3 hours in the morning, but also take all your questions on your stocks, your options, your long-term portfolios. If you're not there, they're recorded. You can also ask me all your questions in our chat rooms all throughout the day. Last, you get access to our educational section where I go over several different option strategies and how I make the most of them, whether it's selling options or buying options. Everything in there, technical analysis, fundamental analysis, how to build long-term portfolios, how to grow trading accounts the right way without taking on excessive amounts of risks. All of that educational section is open to you as well. And last but not least, you get all my charts. All the charts, whenever you see, fundamental analysis or support resistance boxes, you can copy paste all my charts and all my watch lists. It's just an added benefit. It takes 10 seconds. You just copy paste everything and it becomes yours. So all those benefits are included in the link down below in the description. Hopefully I get to see you in the community soon. And if not, I'll see you back on the channel, guys. That's it for me. Take care. I'll try to keep these videos to like an hour 10, an hour 20 moving forward. We're almost done earnings. Thanks for watching these extended videos, but hopefully you guys enjoy the earnings recaps and the longer time that I spend describing the narratives, describing the positioning, and just going over the technicals and giving you guys the levels, right? That's it for me. Take care. Have a great rest of your evening. See you tomorrow, and peace.